Today I'd like to talk about one of my biggest mistakes in the stock market. I bought a stock and didn't make money at all. I even lost money on this one, and I'm making this video so that you don't do this mistake. My name is Christophe Nour, and I've been investing in the stock market for almost a decade with a performance of 24% per year. So my goal with this YouTube channel is to help you become a better investor and learn from my mistakes. So let me get straight to the point. The stock we are going to talk about is Corp. Corp, what do? They sell swimming pools, they sell swimming pool equipment, all the things, heat pumps, all the backyard equipment regarding the pool. So they don't only sell swimming pools, they sell the chemicals, all the equipment that goes with it, the renovation. So Corp distributes swimming pool supplies and related products. It sells national brands and private label products to approximately 120k customers. The products include non-discretionary pool maintenance products like chemicals and replacement parts, heat pumps. In case it doesn't work, you replace it. You call Corp. And pool equipment, packaged pools, kits to build swimming pools, cleaners, filters, heaters, pumps, lights, etc. Customers include pool builders and remodelers, independent retail stores, and pool repairs and service companies. Now you know what they do. This is a distributor. This is a B2B business, and this is the biggest player in this industry by far, like 10 times bigger than the next competitor. So literally we have a business that is very good, very big, working with a lot of clients, and if you check the margins, they are decent, 30% gross margins. And the reason this was a mistake, TLDR, is because of valuation. I overpaid for this one. I bought this stock in 2021, and in 2021, look at the revenue growth. So don't consider the recent decline. Until 2021, revenue was going up every year, up and to the right. Management was competent. Everything was going smoothly. That was perfect. Regarding the net income, until 2021, it was up and up and up and up. So I thought to myself, this will continue. This is a great business, almost a monopoly, distributor. I believe in the growth. This is discretionary and non-discretionary. So in case we have a recession and we don't build as many houses, we don't build as many swimming pools, like 60% of their business is non-discretionary. So it's repairs, chemicals, chlorine. So all this stuff, you need them. Either you pay the chemicals or your swimming pool turns green. So literally every year you have to pay. This is a recurring business model. So yeah, I like it even more. If you look at the cash flow generation until 2021, this is literally up and to the right. You have some cyclicality because they buy just before the inflation kicks in. So they buy at the end of the year to build up inventory. This is a cyclical business, seasonal business, and they do some buybacks here and there. Okay, what about the return on invested capital? Until 2021, going up and up and up. So I thought to myself, this is a business that is growing double digits. Management is good. The growth is good. The margins are improving every year. Gross margins going up. Operating margins going up, net margins going up, return on invested capital going up, and for the balance sheet, you have some debt, but we are talking about a debt of, let's say, $1 billion for a company of $15 billion of market cap. So almost no debt. And okay, so I bought the stock at this moment in 2021, and I bought just after this decline. So let me share with you the stock price from all time. This is a stock that has been compounding at 20% per year for 30 years. So literally we are speaking about one of the best stock from the S&P 500. One of the best investment you could make if you had invested in this stock that sells swimming pool equipment for 30 years. Better than Apple, better than Nvidia at the time, better than most businesses. They sell boring stuff, swimming pools and swimming pool equipment. So this is my kind of business. A simple business that is in almost a monopoly, growing margins, growing revenue. They do some buybacks here and there. What could go wrong? Well, what can go wrong is the COVID situation was earnings there was a pull forward of earnings. In other words, when people were locked in their houses, people remodeled their houses, improved their swimming pools, so they generated a lot of revenue, a lot of earnings in 2020, 2021. And you take your savings, you invest in your pool, and what do you do the next year in 2022? Once your pool is refurbished, you don't improve it again. So literally, they pull forward all the earnings. So they had a spectacular 2020, spectacular 2021, and even though there was some speculation about a decline in revenue, in earnings in 2022, so a return to reality, a reversion to the mean, I said, yeah, the management is so good that I can invest in this business. So I waited. The price went up and up and up and up. I waited for a decline. And now we're talking about a high valuation, a PE above 30, above 35, maybe a PE ratio of 40. So, okay, I waited a little bit and I bought at this level. I started buying at this level. I thought to myself, I'm paying a PE ratio of 30, 35, but it's a growing business. It's a profitable business. And now they announced an acquisition. Okay. Instead of going B2B, it was like B2C. They started to do some B2C things. And the management pitch for the acquisition was big revenue growth. Don't worry, we will find some synergies. You know me, I am very worried when I hear the word synergies because most of the time the synergies, they don't happen. They don't occur. So now I know. I don't expect any synergies. But okay, a big acquisition. And how will you finance the acquisition? Through debt. So, okay, you are here in 2021, new debt to buy pitch a penny, the acquisition target. And it increased the revenue, as expected, a bit more revenue. But what about the margins? It was affected the margins quite badly, actually. So, the synergies did not appear straight away, but we have more debt. So that's a cost. More employees, additional cost. That could be a mess. Instead of going B2B, you are going B2C. So you compete with your own suppliers. That's well, anyway, I did not understand very well the business thesis after the acquisition. So literally, something changed with the acquisition. So I started buying here at a PE ratio of 30, 35. And you know what? The worries about the pull forward of earnings were right. In 2022, revenue went up because of the acquisition, but efficiency and profitability went down. So to calculate your PE ratio, you have the same price, but your denominator, the earnings, are going down. So valuation-wise, you pay a higher price. So I bought at a PE of 30, 35, but in reality, it was a PE above 40. And a PE above 40, this is not a buying territory. Literally, I would never buy again a PE ratio at 35, 40 for this exact reason. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of this video. So earnings decreased. I thought to myself, okay, well, now there is some adjustment, but they can improve again. And you know what? Second half of 2022, again, they decreased the guidance. And in 2023, it was a mess again. And now we are at the end of 2024. The stock has not recovered. The earnings have not recovered. So yes, we are talking about more revenue because of the acquisition. So in terms of number, more acquisition, more revenue, even though in the past 3 years, the revenue is stable. So 2023 is the same as 2021. And as a trailing 12 months, what do we have? Stable revenue. So no growth in revenue anymore. What happened in the past 20 years, 30 years did not happen this time. Stable revenue. So what is the multiple you pay for a business that is not growing revenue? A lot less. What about net income? Net income going down. Oh, that's a mess. That's strange. This is the first time it happens in 15 years for the stock. So literally, the business thesis, the stock thesis has changed on a quarterly basis. Or I don't want to look at it. That's a mess. On a trailing 12-month basis for the net income, decreasing and decreasing and decreasing, decreasing, and there is no floor for this one. So hopefully one day they will recover, but for the moment, the investment thesis collapsed. What about the debt? They paid a lot of debt. so you have interest to pay on the debt, so more cost, and they use some of the cash flow to pay down the debt, but still the debt is more than 1 billion. What about the free cash flow? The free cash flow generation of the business. Now you see some good free cash flow, so that's good management of inventory, working capital, and on a trailing 12 months. What do we have? We have some good free cash flow. Okay, but anyway, the return on invested capital is decreasing. So what I thought of investing in a growing business, more efficiency, more return on invested capital every year, going up and up and up. Look at this. You have before 2021 and after 2021. And I'm the dumb guy that invested in 2020 when all the lights were at the green, where it was peak moment, pull forward earnings. They do some stupid acquisitions that were not efficient enough, no synergy at all, and I'm the stupid guy that bought at this moment. And I'm telling you, so that you don't do these exact mistakes, even though the business is growing nicely, good management, trustworthy management, competent management, good healthy balance sheet, a good cash flow generation, revenue growth, good buybacks at a good moment, don't overpay, because this can happen. The direction of your investment can go either way, to the good moment, right decision, or bad decision. I mean, anything can happen. So that can go to the wrong direction. And right now, because earnings have collapsed and the price has collapsed, we have a PE ratio of 30. Still, even after the decline in stock price, we are talking about a PE ratio of 30. So what I did is I sold a part of my investment. I just sold and moved on to better opportunities that generated a lot of money, by the way. So that's good. And I kept a minimal portion of my portfolio. So we are talking about a few percentages of my portfolio because I believe in the long-term thesis. But I cut most of the position. I sold off because of this bad analysis. So that can happen. And in case you are in this situation and you want to avoid these mistakes, you can check the first link in the description below. I have an investing coaching program where I'm telling you literally all the mistakes you need to avoid and how to invest properly in good stocks like Warren Buffett, like for the long-term fundamental investing, long-term stock picking. So this example is one of many mistakes I did in my investment journey, but I thought I have to share it with you because in this environment we are in 2024, there are a lot of stocks, quality stocks. I'm thinking of the tech right now and AI. Quality stocks, tech stocks that are growing nicely, growing revenue, growing profits, but something can happen. And now they are trading at a rather expensive price. I'm telling you, if you are paying a rather expensive price, like I did with a PE ratio of 30, 35, this is not extreme. This is just rather expensive. If one thing goes wrong and the earnings collapse, are cut in half or decreased by 30%, even 20% decrease in earnings, it will hurt your valuation bad and the stock will collapse. And if the operations are not recovering fast, this will have this exact situation of a stock price that has not moved. We are in October 2024 and this is the same stock price as October 2020. 4 years of nothing. If you include the dividends, maybe you have a quick gain, but 4 years of nothing. You pay too much for an acquisition, you lose the good direction, you pull forward some earnings, you are in a struggling environment, the industry is not consuming as much as before, and you have invested in a bad investment. I mean, this is a good company, but a bad investment for the moment, just because of valuation. So don't do my mistake. Don't invest in overvalued stocks. Just keep investing in great companies at a cheap price. If you like this content, I have an investing coaching program to make you a better investor. In this coaching program, you will learn a complete investing process. You will learn how to find stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. So what comes with the coaching program? You will get access to an exclusive community of like-minded investors, and you will get my personal guidance to help you build the portfolio of your dream so that you can have long-term results with your stock portfolio. Click the first link in the description to get more information. You will get a 10-minute video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.